Welcome to HouseLux Estate, your one-stop channel for all things finance and real estate. Here at HouseLux, we strive to be your compass in the vast ocean of financial information, guiding you through complex terms and concepts that often seem intimidating. Our mission is to demystify the world of finance, making it accessible and understandable to all. We believe that everyone deserves to be financially literate and to make informed decisions about their money. From understanding the basics of a savings account to the intricacies of real estate investments, HouseLux Estate is here to help you navigate these waters with ease and confidence. We're dedicated to providing clear, concise, and accessible financial information, breaking down complex ideas into bite-sized pieces that are easy to digest. We're here to empower you with knowledge, the most valuable asset of all. In today's episode, we delve into the world of banking, specifically focusing on the concept of interest rates and their effects on banking products. Now, what exactly are interest rates? Well, in the simplest terms, interest rates are the price tag on the money you borrow or lend. They're a percentage of the principal amount, which is the original sum of money borrowed or invested. This percentage is what you pay to the lender for the privilege of using their money, or what you earn as a lender for allowing others to use your money. Think of it this way. Imagine you're lending a friend $100. Your friend promises to pay you back, but you decide you want something more for your generosity. So you both agree that your friend will pay you back $105. That extra $5? That's interest. And if you calculate it as a percentage of the $100 you lent, that's your interest rate. In this case, it's 5%. Now, you might be wondering, who sets these interest rates? That's a great question. In most economies, the central bank plays a significant role in determining the base interest rate. They do this to manage economic growth and control inflation. If the central bank wants to stimulate the economy, it might lower interest rates, making borrowing cheaper and encouraging spending. Conversely, if the economy is overheating and inflation is rising, the central bank might raise interest rates to cool things down. But it's not all up to the central bank. Market forces also play a part. Banks and other financial institutions often adjust their interest rates based on the level of risk associated with a loan. For instance, a borrower with a poor credit history might be charged a higher interest rate due to the increased risk of default. So, in essence, interest rates are the cost of borrowing money or the return on lending money. They're a key part of our financial system, impacting everything from the price of our homes to the cost of our student loans. And understanding them can help us make smarter financial decisions. Now that we understand what interest rates are, let's explore how they affect various banking products. Interest rates are the heart of any financial system. They act as a balancing scale, determining the cost of borrowing and the return on savings. Let's take a closer look at how interest rates influence four key banking products: savings accounts, loans, mortgages, and credit cards. First up, savings accounts. When you deposit money into a savings account, your bank pays you interest on that sum. This is your reward for saving with them. Now, when interest rates rise, banks usually increase the rate they pay on savings accounts. So, higher interest rates can be a boon for savers as they earn more on their deposits. Conversely, when interest rates are low, savers earn less. Now let's consider loans. When you borrow money, whether it's for a car or a vacation, you're charged an interest rate. This is the cost of borrowing, and it's how banks make a profit. When interest rates rise, loans become more expensive because the cost of borrowing increases. Conversely, lower interest rates make loans cheaper, encouraging consumers and businesses to borrow and spend more. Mortgages, a type of loan specifically for buying property, also hinge on interest rates. Higher interest rates mean higher mortgage payments, making it more expensive to buy a home. On the flip side, lower interest rates can make home ownership more affordable as monthly payments decrease. Lastly, let's talk about credit cards. Credit card interest is the price you pay for the convenience of borrowing money on the spot. When interest rates rise, the cost of carrying a balance on your credit card goes up. This can add significantly to the cost of purchases made on credit. Conversely, lower interest rates reduce the cost of carrying a balance, making credit cards a more attractive option for consumers. So, as you can see, interest rates have a significant impact on a wide range of banking products. They are a key factor in determining whether it's a good time to save or spend, borrow, or repay. It's a delicate balancing act, with rates constantly adjusting in response to economic conditions. But remember, while it's important to be aware of interest rates, they are just one of many factors to consider when making financial decisions. Your personal circumstances, financial goals, and risk tolerance are equally important. So as we can see, interest rates play a crucial role in determining the cost and benefits of various banking products. Understanding interest rates and their impact on banking products is vital for making informed financial decisions. Why is it so? Let's dive right into it. Interest rates are like the heartbeat of the financial world. They dictate the flow of money, the cost of borrowing, and the reward for saving. They're the invisible hand that guides the economic decisions of individuals, businesses, and governments alike. Imagine you're considering opening a savings account. You have options from several banks, each offering different interest rates. Without understanding what these rates mean, how can you determine which bank offers the best deal? An account with a higher interest rate means you'll earn more on your savings over time. Or perhaps you're thinking about taking out a mortgage to buy a home. Here, a lower interest rate can save you thousands of dollars over the life of the loan. But how can you know this if you don't understand how interest rates work? Understanding interest rates also helps you manage your finances better. If rates are high, you might decide to save more and borrow less. If they're low, you might choose to borrow more and save less. This knowledge allows you to adapt your financial behavior according to the economic climate. Interest rates can also affect your investment decisions. If rates are high, bonds become more attractive since they offer a fixed return. But if rates are low, stocks might be a better choice because they have the potential for higher returns. Understanding this can help you build a more effective investment portfolio. Knowledge of interest rates also empowers you to ask the right questions when dealing with financial institutions. You can ask why a rate is high or low, what factors influence it, and how it's calculated. This can help you avoid pitfalls and make the most of your banking products. So, understanding interest rates isn't just about making smarter financial decisions. It's about gaining control over your financial future. It's about making your money work for you rather than against you. It's about financial freedom. By understanding interest rates, you can make your money work for you rather than against you. So, to recap today's discussion, we've taken a deep dive into the world of interest rates and their profound impact on various banking products. We started off by understanding what interest rates truly are, the cost of borrowing, or from the perspective of the bank, the price of lending money. We've learned that these rates are not just arbitrary figures, but are influenced by a myriad of factors, including but not limited to economic conditions, inflation, and the policies set by central banks. We've also uncovered that they play a significant role in the financial ecosystem, serving as a critical tool for monetary policy and a key determinant of economic health. As we journeyed deeper into the subject, we unraveled how interest rates directly affect banking products. For instance, we discovered that a rise in interest rates can make loans more expensive, thereby discouraging borrowing and encouraging saving. On the other hand, a decrease in interest rates can make borrowing cheaper, thus stimulating spending and investment. Moreover, we highlighted the importance of understanding interest rates. We emphasized that this knowledge can help you make informed decisions about your financial endeavors, be it taking out a mortgage, investing in a savings account, or even starting a business. The more you comprehend about interest rates, the better equipped you are to navigate the financial landscape and optimize your financial health. In conclusion, interest rates are more than just percentages on a page. They are a fundamental part of our financial system, influencing our economic behaviors and shaping the dynamics of various banking products. By understanding their mechanisms and impacts, we can better manage our finances, take advantage of opportunities, and mitigate risks. Thank you for joining us on House Lux Estate. Don't forget to subscribe for more insightful videos on finance and real estate. Until next time, keep your finances in check and your investments growing.